Hello and welcome back to another video with us from Artificial Channel. Now we will be discussing about money and money supplies. Please stay tuned and enjoy the video.
Okay, now we are going to talk about money and money supplies. So, we start with the question. What do you feel when you see this? What do you feel when you see this? You see this? Please write your answer, comment below. You're probably going to say that you want it, you love it, you need it, maybe you need it for dating, you want it to buy food, maybe you wish you can have them, or maybe you want to have more. And maybe some of you will say it is really hard to find and etc. But did you know that between surat mantan or letter of your ex and the money is both are equally paper? Did you know it? And you can buy food with money. Of course, you can buy anything with money, but you cannot buy food with surat mantan. For example, you can buy 8 bakso with 100 rupiah, and you cannot buy anything with surat mantan. You only can buy 0 bakso with surat mantan. But why can it happen? The question is why. To answer this question, we need to look at the history of money. So the history of money is start with this. This is barter. Barter is when you exchange or you trade goods with another goods. For example, in this picture, you can see this guy is trading his meat for a fish. But this kind of method is somehow causing a problem. For example, he maybe say meat for fish, or he say, no, this fish is more expensive. I caught it bare hand. You should give me 2 meat. And he say, this is my pet, and they fight. This is a problem of barter. So because barter is a problem when you trade something, so the population or the society is moving into a new kind of method. They move to the currency. The currency is start with this money goods. For example, Roman soldiers were paid by salt. Salt in Latin is salarium, and the word salary in English is derived from this word salarium. So if you were a Roman soldier, you will be paid by a salt. But also, this kind of trading method have a problem. The problem is salt time by time will be decreasing over time. If you just put it on the open air, then the salt will be decreasing. So this is a problem. Because this is a problem, then we move into a new kind of method of trading, which is the first coin. This is the first coin that ever known. This is electrum that found around 600 before century. It consists of 75% gold over 25% silver. This is the first coin. And then because they are using coin, so people were using gold for trading, because this coin are made by gold and silver. So people are enjoying and used to trade with gold. And time passed by, then the bank first introduced to the society. This is the first bank. And what happened is, because gold are highly potential to be stolen and heavy to bring, then people on the time used to save this gold on the bank. So people got guarantee letter after saving the gold in the bank. They save this and they get this. The next is, this is the summary of it. They save the gold in the bank and they get the guarantee letter from the bank. Because these guarantee letter are so famous in society, the society use this guarantee letter to trade to buy something. And for example, you can buy, if we still use this guarantee letter on this time, we can buy perhaps one bakso with three letter of guarantee letter. So people are comfort using paper for trading. And because they are comfort using this paper for trading, then we come to this. Then people agree to use paper money for trading. That is the history of how we can get this today's money. So in summary, we have that first, as a human, we use this method. We barter to exchange a goods for a goods. Then after that, we have this. This is the money goods. For example, salt that has been paid by the Roman soldier to their other soldier. So after this, we have this. We have coin and gold, and after coin and gold, we have guarantee letter, and after that, we have this. We have this money, paper money, and today we have this electronic money that are not there are not very comfortable to use for many people. For example, the poor people that cannot use this. So the definition of money with that all of history is: money is any item or verifiable record that is generally accepted as payment for goods and services, and repayment of debts such as taxes in particular country or society economic context. This is the function of money. First is medium of exchange, the second is unit of account, and the last is store of value. Now we come to the question. Define money with very simple sentence. Next, we are going to talk about the types of money. So we are going to talk about this. First, commodity money. Second is representative money. And the third is fiat money. So let's start with the first one. The first one is commodity money. What does it mean by commodity money? Commodity money means that a money whose value comes from a commodity of which it is made. So for an example, we can see in this picture, we have this fine silver and fine gold. If this fine gold value is, for example, just let's say 1 million rupiah, then the money, the commodity money of this fine gold will be 1 million rupiah. And if this fine silver equals to, for example, 500 rupiah, then this commodity money will equals to 500 rupiah. This is what we call as commodity money. The next one is representative money. Representative money is any medium of exchange, often printed on paper, that represents something of value but has little or no value of its own. So for an example, just like what I explained before, we have this guarantee letter to represent this gold, their gold on the bank. So this, we can call this as the representative money because it represents this. It represents some goods or some medium, some goods or some commodity that have its own value. The next one is fiat money. Fiat money is a type of currency that is not backed by any commodity such as gold or silver and typically declared by a decree from the government to be legal tender. So fiat money, for an example, is this, our rupiah. This is fiat money because it doesn't have backup commodity such as gold or silver. It doesn't represent something, but it stands by its own and declared by a decree from the government to be legal tender. So this is the difference between commodity money, representative money, and fiat money. The characteristic of commodity money has backed commodity, and also representative money, yes, but fiat money doesn't have back commodity. So this is the difference between commodity money, representative money, and fiat money. And about the the characteristic of represented, the value of its commodity money, it's obvious, it represents the value of its commodity. And also representative money and fiat money doesn't represent the value of its commodity. And the last is the low intrinsic value. What does it mean by intrinsic value? Is the value of for example, the value of this paper, the value of this paper, also the value of this gold. That is what we meant by intrinsic value. So low intrinsic value, commodity money, of course, obviously not, because it has high intrinsic value. Representative money, low intrinsic value, yes, because this is only just a paper. And fiat money, obviously, yes, it has low intrinsic value. So we come to the question, what is the difference between commodity money and representative money? Question, what is the difference between commodity money and representative money? This is number 4. Next, we are going to talk about understanding money supply. So, this is the data of Indonesian inflation, annual Indonesian inflation. This is the data that we take from data box. So, as you can see here, this is what we remark by red circle is the peak of inflation in Indonesia. What caused this? This is caused by too much money that's circulating in society. And also, we have this. We have this downturn that caused by the money that's circulating in society are too low. So to explain this, I want to give you a very simple explanation. Imagine you have this one bowl of bakso. You have the quantity as one, and you don't know the price. The price is unknown. And let's say that we have three people here, three person in, let's say in Indonesia, we have three person in Indonesia. And each of them has 12 rupiah on their pocket. They have 12 rupiah on their pocket. And they are demanding for this bakso. Because they are demanding in this price, then the price of this one bowl of bakso will be more than 12 rupiah, because every of them are demanding in the price. So the price needs to be higher, so we can have one of them that will pay with the price that we give. What does it mean? It means that the more money that's circulating in society, for example, they have 12 rupiah each of them. The more money that's circulating in society, the price of all goods will be increased. Because these three people have 12K, then the price of bakso will be increased because these three people are demanding for bakso in the price. This increase of all price are called inflation. You can imagine this as all goods in let's say in Indonesia. So what happened if they only have 10 rupiah each of them on their pocket? The rest of it on their bank account. And the price of bakso is 12 rupiah, and the quantity is only one. What will happen is the price of bakso, this one bowl of bakso, will be decreased below 12 rupiah. For example, 10 rupiah as what their demand, or maybe 11 rupiah or 11.5 rupiah. You say that. So what does it mean? It means that the less money that's circulating in society, the price of all goods will be decreased because they only have this and this on their pocket. So because the money that's circulating is only this, what happened is the price of all goods will be decreased. Because these three people cannot afford the price, then the price of this bakso will be decreased because these three people are demanding for bakso in lower price. This decrease of all prices are called deflation. Key takeaway. First, if people have more money on their pocket, the price will increase, or we say inflation, because people can afford goods and service. Let what we meant by money on their pocket, because one people maybe have money on their saving account and their consuming account, which is their pocket. This is what we mean by money on their pocket. So next is, but if people have less money on their pocket, the price will decrease, or we call deflation, because people cannot afford goods and service in the price. So we see these days again, the annual inflation of Indonesia. We can see here, this is caused by too much money that's circulating in society, and this is caused by the money that's circulating in society are too low. What happened is, if the money supply is too low, the money that's circulating in society are too low, then the government will supply money, more money. And if it is too high, then they will decrease money. But how they do it, we will see on the next discussion. But before it, we need to answer this question. What causes inflation and deflation?
In Indonesia, who is responsible of maintaining price stability? The answer is Bank Indonesia, or BI, which is the central bank of Indonesia. Now if I ask you, do you think that Bank Indonesia is the same with these banks, Bank BRI or Bank Mandiri? The answer is no. Now let us see the brief history of Bank Indonesia. Back in the era of the Dutch East Indies government, the Java's Bank was founded in 1828. The Java's Bank was in charge of printing and circulating money. About a century later, in 1953 to be exact, Bank Indonesia was formed by replacing the function and role of the Java's Bank. The goal of Bank Indonesia is to achieve and maintain the rupiah's value stability. Well, to achieve this goal, Bank Indonesia has the following tasks. First, establish and implement monetary policy. Second, regulate and maintain the smooth running of the payment system. And the third, regulate and supervise banks. The main function of Bank Indonesia, which is achieving and maintaining rupiah stability through the management of the monetary, payment system, and the financial system stability sectors. Now, what roles do Bank Indonesia actually plays? First is Bank Indonesia as a government bank. Second, Bank Indonesia as the bank of banks, which is BI is the lender of last resort. The third, Bank Indonesia as money market regulator. And the fourth, Bank Indonesia as circulation bank.
Bank Indonesia has monetary policies. Right now, you guys might be thinking, what is monetary policy? Monetary policy is government policy to control the economy through the amount of money supplied by Bank Indonesia. There are two types of monetary policy. The first one is quantitative policy, and there are three. First is open market operation. Second is reserve requirement. Third is discount rate. And for the second monetary policy, which is qualitative policy, it is selective credit control and moral suasion. Now, on to open market operation. Open market Open market operation, or OMO, is an activity by a central bank to give or take liquidity in its currency to or from a bank or group of banks. The central bank can either buy or sell government bonds or other financial assets in the open market. This is where the name was historically derived from, or in what is now mostly the preferred solution, enter into a repo or secured lending transaction with a commercial bank. The central bank gives the money as a deposit for a defined period and synchronously takes an eligible asset as collateral. Central banks usually use OMO as the primary means of implementing monetary policy. The usual aim of open market operations is, aside from supplying commercial banks with liquidity and sometimes taking surplus liquidity from commercial banks, to manipulate the short term interest rate and supply of base money in an economy, and thus indirectly control the total money supply, in effect, expending money or contracting the money supply. Reserve requirement. A reserve requirement is a central bank regulation that sets the minimum amount that a commercial bank must hold in liquid assets. This minimum amount, commonly referred to as the commercial bank's reserve, is generally determined by the central bank on the basis of a specified proportion of deposits liabilities of the bank. This rate is commonly referred to as the reserve ratio. Though the definitions vary, the commercial bank's reserves normally consist of cash held by the bank and stored physically in the bank vault, plus the amount of the bank's balance in that bank's account with the central bank. A bank is at liberty to hold in reserve sums above this minimum requirement, commonly referred to as excess reserves. This measure is commonly referred to as the liquidity ratio. In short, reserve requirement is the determination of the cash reserves and minimum statutory reserve that must be deposited by commercial banks. Commercial banks have two reserves in Indonesia. The first one being cash reserves, or money collected from the public is kept in the form of cash at the Bank of Indonesia. And the second is minimum statutory reserves, which is commercial bank account at Bank Indonesia. For example, money statutory reserves 5%. Bank X collected funds of 1 trillion this year. Then it must deposit to the Bank Indonesia of the total amount of 5% of 1 trillion. Next, which is the discount rate. What is the federal discount rate? The discount rate that we're speaking right now is about the federal discount rate. So what is it? The federal discount rate is the interest rate set by the Federal Reserve, or Fed in short, on loans extended by the central bank to commercialized banks or other depository institutions. Adjusting the discount rates allows central banks such as the Fed to reduce liquidity problems and the pressure of reserve requirements, control the supply of money in the economy, and basically assure stability in the financial markets. There are key points on this, which is the first one being the federal discount rate is the interest rate the Federal Reserve, or Fed in short, charges banks to borrow funds from a Federal Reserve Bank. The second key point is the Fed discount rate is set by the Fed's Board of Governors and can be adjusted up or down as a tool of monetary policy. How the federal discount rate works: in addition to its other monetary policy and regulatory tools, the Fed banks can lend directly to member banks and depository institutions. This is part of the primary purpose of the Fed as a lender of last resort to ensure the stability of banks and the financial system in general. The discount rate determination of the interest rate charged to commercial banks from Bank Indonesia. Banks should reduce the discount rate during weak economic conditions and also deduct the value of the loan against its nominal value. For example, discount rate of 5% for SBI with 1 billion nominal value sold 950 million and a 5% cut at maturity 1 month later. Bank Indonesia redeemed SBI worth 1 million. Now on to the qualitative policy. The first one is selective credit control. What is selective credit control? It is the supervision that lending is prioritized in productive sectors. What will be monitored is the type of loan and the form of investment made. And finally, for the moral suasion, banks or Bank Indonesia will make an appeal or invitation to commercial banks to assist the government in implementing certain programs. On to the question: what are the roles of Bank Indonesia? Thank you. That is it for today's video. We hope to see you guys again in the next week. Stay tuned for further videos. Thank you. God bless.